Today, we're fortunate to be in the company of Delia Dean, who will speak about the access to finance and market challenges for women engaged in cash crop value chains. Delia, she comes from a background of having worked with the UN and the World Bank and national governments, and I'm personally very excited to have you on board here today, Delia. So thank you for that. As for the format, we will start with a 20-minute presentation from Delia, and thereafter we have 20 minutes for questions from the audience. You can post your questions in the chat, or you can raise your digital hand. I also need to say that we are recording this session because we know that many people who are not available today, they will go into our website and listen to the talk later. I think that is it from my side. But Delia, thank you very much for being here today, and I'll hand over the screen to you.
Great. Thank you very much, Thomas. Good morning, everyone with the A2i team. I'm really honored to be here. Thank you so much for inviting me to have this conversation with you. And for the rest of the audience, thank you also for making the time to engage in this dialogue. The topic of interest is one that I'm definitely very passionate about. And so let's just let me know when you can see my screen.
We can see it now.
Okay, great. So I've narrowed down my focus today on access to finance for rural women, particularly those engaged in agriculture, because for most of sub-Saharan Africa, we find upwards of 70% of women have agriculture as their primary source of income, even if it's for subsistence living, and they do participate in different stages of most of the agriculture value chain, but predominantly in the primary production. And one of the challenges that keeps women's incomes in this sector stagnated is the barriers that they face with regards to accessing finance. To get an understanding of the complexity that women face, it'd be interesting to look at the context that, for example, in Uganda, but it applies by and large to Greater East Africa, where agriculture is, upwards of 70% the main livelihood of the population. Women make up 55% of the economically active population in agriculture. And women in agriculture provide 80% of the labor across the value chain. Over 90% of farm-level primary processing operations is conducted by women. However, women have more agency over loose, unstructured value chains like agriculture. And what this means is that whereas they might provide, more than 90% of the farm-level labor for the cash crops like coffee, tea, cotton, bananas, their agency on the incomes is close to negligible, because then the men take over when it comes to the marketing functions. And so the incomes end up directly in the possession of the men in the structured traditional cash crop value chains. So women have no agency on income in more productive, predictable, and higher value cash crop value chains. Women also have the challenge of lower investment due to land tenure insecurity. Less than 20% of women in Uganda own land with title deeds in their own names. And so a lot of their ownership or their tenure is pretty much tied to the lifespan of a male relative. It could be a brother, a son, a father, or a spouse. And also speaking on the land tenure insecurity, what we will see ahead is the fact that for most of this region, land is a major collateral asset. And so when women do not have land tenure instruments, then it's very difficult for them to use these as tools for accessing credit. There is also low farm holding productivity for women because of a couple very significant barriers, but some of this has to do with the fact that women are the primary caregivers in the homestead, and so their time is competed for between household care and productive activity on the farms. They also have limited or close to no access to improved inputs like seeds and fertilizer, and this is due to a low capacity to afford these and the inefficient knowledge on how to apply these inputs as if and when they do have access to them. They also have limited or no access to mechanization tools. And so a lot of women's activity is very manual. And what we find is often that their farms and gardens are not prepared in time. So they're always running behind the clock. And a lot of times they miss the key seasonal milestones for when to prepare the gardens, when to sow, when to weed, and so on and so forth. And then that ultimately impacts their productivity at the end of the season. They have limited capacity to afford outsourced labor so that they can cover more ground. And also women have very fragmented plot sizes, which makes it very challenging for them to engage in commercial agriculture. And if we look at the plots managed by women, these produce 13% less in terms of gross value of output per acre on average than plots managed by men. And this can be, again, attributed to what I've mentioned above, the fact that there is a time poverty for the women, there is limited access to inputs, and when the access is there, it's not timely, but also the inability to farm greater chunks of land in a timely manner. In the financial space, in Uganda in general, only 9% of adults own a bank account. And this is further exacerbated when it comes to women. And we find that women use informal services, like 50% of women use informal services to access credit for predominantly consumption, smoothing, and micro investment purposes. 3 out of 5 women cannot raise emergency funds if needed, compared to 50% of men. The average loan size in the financial industry currently for microfinance institutions is about $700. So when you think about what is the potential of the $700 actually enabling commercial scale agriculture for female smallholders, you can see that in of itself is very limiting. And that's again tied back to the value of the collateral that women have at their disposal. Again, within the financial industry, because of women's low financial profiles, lack of transactional histories, low value collateral, we find that in the agriculture lending space, only about 30% of commercial bank lending portfolio goes towards women in agribusiness. And then specific to access to formal finance barriers, of course, we have the challenge that's persisted for quite a while now, which is the low financial literacy, the ability to know and to choose the best possible financial products and services, and even the best possible vendor for a particular business remains a challenge for many women. Affordability is a big challenge. Currently in the market, the average agriculture loan facility is being extended at an interest rate of 18% to 36% per annum. There is also limited access to suitable products and services that are tailored to match women's life cycles, but also the agriculture productivity cycle. Most of the loan tenure is between 4 to 18 months, which is really not realistic, especially if you have a bimodal production cycle where there's a lot of what I would call non-productive months where the crop is in the ground and you're just waiting for it to mature. However, the loan terms do not take these dormant periods, productive periods into consideration. if we look at Northern Uganda as a case study, and the reason I highlight Northern Uganda is because it's been predominantly the most underserved region or underdeveloped region from a socioeconomic perspective in Uganda. So 50% of the women in Northern Uganda do face a gender-specific challenge in accessing finance. It's the lack of property for collateral. There is the marital and domestic obligations in the home, the lack of confidence from financial institutions to lend to women-owned businesses in Northern Uganda, and the proposed volume of loan expected of a woman. So women are unable to secure larger ticket size loans to accelerate their business growth. There is also the heavy burden of documentation and the need for formalization, where a lot of the business development centers and formalization centers are not very well distributed across the country. And so there's the burden of travel to formalize just so you can access credit from a formal financial institution. I mean, if you look at it, 37% of the women, it took them 2 years to access a loan from the time when they started the process to when they were able to get a loan. So if you look at that, that's about 4 planting seasons before you can actually access a loan. And for 37% of women, the other 37%, it took more than 2 years for them to access this commercial loan. The loan repayment structure as well is not very suitable for women, but also in general, the way the agriculture production cycles evolved. And so you find that there's a lot of, within the balloon payments at the end of the loan tenure, you also have the quarterly payments and you have the monthly payments, which, as I mentioned, when you have those inactive periods of agriculture productivity, there is not, you're unable to finance that loan. And also the loan sizes are pegged to the value of the collateral. Access to alternative non-commercial bank financing still lags behind for most rural women. And this is because alternative financing mechanisms are very dependent on digital tools and platforms, and we shall speak a bit about that a little later. And so we find that alternative investment like equity financing, angel investment has not been feasible for a lot of women-owned agribusinesses, where we find that 60% of investment managers, only 60% of investment managers sourced for women-owned businesses with a level of difficulty rating of 40%. So even when there is a deliberate effort by investment firms to seek out women-owned businesses, it's really difficult to get businesses that have the necessary formal documentation to process that line of credit. So on the demand side, this is just a quick summary on the demand side, is access to collateral is a big barrier. The low adoption of digital technologies, that's digital financial services and digital enterprise management systems, makes it very difficult for agri-based SMEs to be bankable. And then the digital alternative lending is also very limited for women because they have close to no financial profiles to enable credit scoring, which would in many instances lend to more innovative ways of structuring products and services suitable for women in agriculture. There is also very low uptake of agriculture insurance in general in Uganda. As of about 4 years ago, it was less than 15% uptake nationally of agriculture insurance. There has been some development due to a government public partnership, and the results are still out on that one. On the supply side, interestingly, also for the entities that would be interested in trying and extending alternative or innovative lending facilities to agri-SMEs, they too find themselves capital constrained because their financial models are not appreciated by the commercial banks. I'll give an example of, we have two providers. One is Patasente, and Patasente is a supply chain, it's one of the few supply chain financing providers in the country, but they struggle to serve multiple businesses because they are unable themselves to secure large enough credit from either the development banks or commercial banks to then on-lend to SMEs. We also have in Subuco, that's a platform that's supporting linkage banking between village savings groups and savings and credit cooperatives into larger commercial banks, but they too become constrained in the number of community members that they can support because of their own capital constraints. Also on the supply side, there's definitely an inconsistency in collection and use of gender disaggregated data. And the challenge with this then is it's very difficult to then, even, now we're in the era of increased use of artificial intelligence, but this artificial intelligence needs vast amounts of data to be able to derive meaningful solutions. And so the dearth of optimization. So in addition to the direct financial barriers, we also have to be cognizant that they are intersectional barriers. As I said, when I was starting out, women's financial lives are complex and they don't just fit in one nice, neat box. And that would be to say, we have a market linkages challenge, and we have the digital gender gap challenge, as well as social norms. On the market linkages challenges, there is limited technical know-how to market beyond immediate network, and there's poor or low e-commerce technical capacity. And what this means is that even when there are programs that extend grants or de-risked capital to women-owned SMEs, their ability to absorb and turn around that capital and grow the businesses is limited by the market linkages challenges. We have also a challenge increasingly in the past couple of years of a misplaced value addition, where through multiple development sector interventions, we have improved practices in, for example, honey production, dried fruit, mushroom production. However, this is being done for low value markets and not for high value markets. And what this means is we've improved the quality, but there's a mismatch on where these products are being sold. For those of you that are familiar with East Africa, it's a place where the consumption of fresh organic produce is still very much possible. And so people are less likely to pay a premium for a product that's been processed and added value to in terms of preservation of that product when the fresh alternative is still very much available. And so that disconnect between having improved the quality of the product, but mismatching it with the market it's being marketed to. There is also low aggregation capacity of women-owned SMEs to trade with larger off-takers. I did a study a couple months ago, and this was just an assessment of the different cottage business development hubs. So women have been grouped according to their particular trade, whether it's mushrooms or dried bananas and what have you, and have come together and they're doing solar enabled drying or grinding and milling and what have you. But the pity of it is that at no one point are they able to aggregate demand and also aggregate their supply consistently. So you have a product, but there is also that inability to network and to grow the volumes of production consistently. And for as long as that exists, then you have a lot of assets that have been financed, like the solar dryers, the milling machines, and the grinders that are under financing arrangements right now, and a risk for delinquency because of that inability to aggregate demand. We also have a challenge of low development program resource and impact staggering to promote concentration in areas of competitive advantage. And what this means is, for various reasons, and many of you who are in the development sector, I'm sure you're very familiar with this, it's the fact that we have a series of programs that are very, well designed, but do not speak to each other. And so then there is a fragmentation of the output. And by this, so we will find many scenarios where there is no concentration on competitive advantage, in the sense that should women's small cottage industries be focusing on primary production? Should they be focusing on value addition? If it's value addition, which crop chain? If you go to some of these hubs, you will find somebody's doing a bit of bananas, a bit of peanuts, a bit of maize flour, which then is definitely wasteful when it comes to resources. So that's an area where there's definitely room for improvement with regards to resource staggering and a concentration on areas of competitive advantage. The next interconnected barrier has to do with the digital gender gap. And the reason why this is very important right now in our context is the fact that banking is going digital. And in East Africa right now, especially with the onset of what we call agency banking, very many commercial bank branches are being closed down. And so the mobile phone has become increasingly the primary tool to access financial services. However, because of a prevailing digital gender gap, it means now that women are, unless there is deliberate intervention, women are more likely to fall further into the cracks with regards to disinclusion from financial services, as there's a greater migration towards digital platforms. As you can see from here, over time, access to the mobile phone has improved for women. The gap is not that significant. However, ownership, there is still a significant gap. And what that means is women might have access to a phone through a family member or a friend or a community member or the mobile money agent. However, they do not own this device. The basic phone skills, like just making a phone call or sending an SMS, men and women are at par. However, when it comes to advanced phone skills, this is the ability to navigate and manipulate applications, whether it's a banking application, an education application, a health application. We can see that 15% of women have advanced phone skill capability compared to 41% of men. And then the usage of digital innovation platforms, there also is a gap there. So as we have more firms developing very unique and innovative products and services and alternative microfinancing products and services, we've still noticed that women remain behind the gap because of this, the digital skills gap, and also the affordability of accessing these platforms. When it comes to the major hindrances to access, usage, and adoption of digital technologies for women, this was a case study. I believe we had over 2,500 respondents from different parts of the country, and resoundingly was the affordability is the main constraint for access and usage. So even after an individual has purchased the device, the ability to keep it charged, the cost of keeping it charged, and the cost of airtime. What would airtime be? The service, basically the GSM service, and also the cost of data bundles is a barrier, remains a barrier for smallholder female farmers. Also, low digital knowledge and product awareness is a barrier to adoption and repeat usage. And this is also exacerbated by the fact that the existing training and outreach models have a limitation in the sense that they're by and large designed and structured in a way that they are accessible in places that men frequent and along the timelines and daily routine cycles that are suitable for men versus women. So even if there is digital literacy going on, a lot of times women do not have the luxury to attend this upskilling sessions. Social norms also significantly limit women's adoption of digital technologies. I'll speak a bit more about that in the next slide. And then there's the gender blind project design and implementation laws and policies when it comes to digital human capital development for women in the digital space. We do have, as mentioned, social norms are definitely a barrier for women's access to digital platforms, which then influences or limits their access to digital financial services. And part of this had to do, excuse me, part of this has to do with the fact that men dominate the ownership of capital assets at the household level. And a phone is, in many of the rural households, a phone is considered a capital asset. And violation of the social norm sometimes can trigger gender-based violence. In one of the questions that we had, we had a question on, should women be supervised when using bank accounts, and resoundingly men would come up and say, yes, women need to be supervised. So if she's using the phone to do mobile money, she should do it on my phone so that I have visibility on her transaction history. In terms of, so if we look at, sorry, just one second. So the phone is a source of information and channel for income generation. So therefore, men must have the first priority, and the privacy for women and digital platforms, especially with regards to finance, is very restricted. Women also have very limited time, free time to obtain skills and for digital technologies and knowledge dissemination. The current product offerings on the digital platforms as well is an additional problem, where the products are not designed in a manner that is also suitable for women. And one of the most basic things that we keep coming across is even just the language of the menu or the language of the call center when the women call in to get help after a service like micro crop insurance has been sold. Can they reach somebody on the other side to advance their claim, to understand the terms and conditions of the policy that they're purchasing? And that still remains a barrier. The other challenge, of course, that is given our youth, a huge youth population in most of sub-Saharan Africa, is the low participation of women in STEM subjects. And we see that this later on has an impact on their willingness themselves to adopt the use of digital products and services. We can skip over this one. So with regards to access to finance consideration, there's definitely a range of interventions depending on what stage of whether somebody is intervening at the supply side or the demand side. There's definitely a range of impactful and meaningful interventions. However, I have narrowed this to three areas that keep coming up in the lessons I learned from the work that I'm doing. And one of them has to do with consumer segmentation. There seems to be an increasing consumer or client-based blindness, where there is this push for making everybody an entrepreneur. So the idea of job creation through entrepreneurship. And it very much doesn't take into recognition the fact that we will have households whose only greatest extent in agricultural productivity is for consumption smoothing. And so increasingly now we have social protection systems that are cognizant of this, and they are now using some of the social protection grants to catalyze some form of, let's say, community level asset accumulation. And it's just being cognizant that for the very elderly, for women that are really in the middle of their childbearing years, for women that are in the primary responsibility of taking care of elderly women and cannot manage an enterprise, their ability to grow businesses and absorb credit is very limited. And so the focus should be on really identifying through pipelines those individuals that have the capacity to establish and grow businesses and thereby create jobs, and then to also facilitate the direct integration of these enterprises into value chains, into the supply value chains.
Delia, I think we need just to speed up a little bit if we need time for questions.
Yeah, I've got just 4 slides to go.
Okay.
The other one has to do with product suitability. I've spoken about this quite intensively. The third one is risk sharing facilities and guarantee funds. There has been an increasing, well, when I say increasing, maybe there's about every 5 years, there's probably about 3 or 4 risk sharing facilities or guarantee funds with a component or a window that's focusing on women in agriculture, SMEs. These need to continue to grow, and their eligibility criteria need to become less complex and easier for women-owned SMEs to access. I'm just going to share some very quick case studies that these are evolving that I like to keep track of. So we have a company called Numida, and Numida uses pretty much, I would say, AI to extend working capital loans to small SMEs. And they've been able to extend upwards of $7 million to 25,000 SMEs in Uganda for working capital. However, because of the riskiness of agriculture, their business model at the moment does not allow them to target agriculture SMEs. So my question is always, how impactful would the customization of the Numida model be for agri-based SMEs? Because if they've been able to have so much impact on non-primary production businesses, then there's probably room for exploration. The second case study is from a just concluded program that was financed by the UK Foreign Commonwealth and Development Office. And this one was a financing facility, a de-risking facility that enabled women in northern Uganda to actually have access to asset financing. And the case study of Beatrice Ajik is that by being able to get this credit of about £11,000, she was able to purchase a tractor. And by doing that, she's now able to farm up to 100 acres of land. And part of it she owns, and part of it is she leases. She leases from other community members. But prior to this de-risking facility, there was just absolutely no way that a woman like Beatrice would ever be able to qualify for this type of credit. Let's see. I guess on the recommendations, I can just go really quick on the recommendations. The first one has to do with integration of women-owned businesses into larger supply chains so that they can then leverage supply chain financing because of the downstream and upstream credit histories that are built, as opposed to women businesses that are operating in isolation. We need to continue to use human-centered design in the development of financial products and services for women, to test and iterate these bundled solutions, because we find that women, especially rural women, are better served by bundled solutions because of they don't have the time and the capacity to manage multiple financial and health products and services. Increase the number of financial risk sharing facilities and guarantee funds, and de-risk the piloting and of alternative financing instruments, like crop receipts, asset financing for non-traditional cash crop value chains like horticulture, where women have a higher participation rate, but also agency over the ultimate income. I think I will, Thomas, I think I will stop there in the interest of time, because I've spoken over some of this earlier in my presentation.
Okay, thank you very much, Delia. If you can stop sharing then we can see each other. Thank you very much for this very interesting and I would also say somehow alarming perspectives on the access to finance by women. I think you highlight both the structural challenges, but also some of the social constructive challenges that are faced by women in the agriculture sector. So very interesting. Please, if anyone have questions, you can post them in the chat or raise your digital hands. We have time for a few questions. In the meantime, I do have a question. So I think one thing that puzzles me a little bit, you would always assume that lending capital would go in directions of low risk. And I think we also have a lot of evidence from women-led saving and credit groups that you have very much success on repayment in these groups. So it doesn't, it's kind of irrational that the lending capital doesn't kind of look in those directions when you have these success rates. How can you, is there any explanation for that?
Yeah, so that has to do with a dysfunction in the larger financial industry in Uganda, and that has to do with the fact that our commercial banks they make easier money lending to the government and to other banks than lending to consumers, and it's just a structural challenge that the central bank is trying to address, because one, if you're lending to the central government or you're lending to another commercial bank, you don't really need to leave the comfort of your banking hall, but going out to these multiple savings groups and collecting their information, it requires multiple trips to go there. Sometimes they don't have all the necessary documentation. You have to teach them, you have to invest money and patience in the financial and digital literacy. Then there is the whole process of the loan monitoring and then the recouping of that loan. So it's just a mismatch in incentives as far as revenue and profitability for commercial banks is concerned. And that's why we find that increasingly where there has been a great impact in access to finance for women SMEs, there has been a development sector partner push and collaboration with a private sector bank.
Interesting. Okay, so if I don't see any digital hands, I'll just continue asking questions. Please don't be shy. I think it was this barrier about having access to collateral, the whole land tenure issue. Do you see any reforms in Uganda or in the region that tries to change that?
Yes, there's a lot of acts and bills that are loitering somewhere in the hallways of the parliament that have been developed with support from the likes of the US government around issues of land tenure. If we look at, for example, Rwanda's made significant stride and improvement with regards to land tenure for women and the laws and regulations around husbands and wives and asset ownership. So in the context of Uganda, it's work in progress.
Okay. When we look at the cost of capital, you mentioned these interest rates between 18 to 36%.
Yeah.
How much of that is due to inflation rates, and how much of that is due to a history of poor repayments on loans in general? Can you kind of look at it?
I think most of it is just the presumed risk of lending to women. It's the cost of it's really two cover for the low quality or low value collateral that is exchanged for this credit.
Okay.
Yeah.
So when you look at the private and the public market, is that for lending, is that pretty much the same rates or?
Public and private?
Yeah.
Pretty much.
Okay.
Pretty much.
Okay, but
and that's why we find that there's been significant so when entities like UNCDF apply the blended financing models to kind of offer a loss guarantee to commercial banks in the event that there is a loss, then they have a greater appetite to serve more high risk consumers.
Yeah. Okay, if there are no further questions, I just have a small announcement. Yes.
Can I say something?
Yes, Robert.
Oh, thanks so much, and thanks so much, Delia, for your presentation. Most of actually your points are actually very spot on, and it actually depicts what is contextual in northern Uganda. I work for TechnoServe Uganda, and I've been in this region supporting quite a number of private sector actors. But what I could say is that we already see a lot of benefit that accrues to women, that goes to women support. Especially, I want to give a case whereby women entrepreneurs engage in aggregation of products from smallholder farmers who actually have a level of accessing finance. There are quite a number of benefits that actually goes directly to the farmers who work with women entrepreneurs. And if we could find a way of how we target some of these women entrepreneurs to also advance this kind of support to the smallholder farmers, it gives a benefit both end to the smallholder farmers, but also to the private sector, whereby it has been a case of the quality aspect, that things that come from farmers to the companies. For instance, I give this example actually in the oil seed and cereal companies who are working with women. And so it will be a very good case of maybe if there are development agencies who can target those kind of MSCs who are owned by women. Thank you.
Thanks, Robert.